It's when you're sitting around the kitchen table paying bills. It's the monthly payment.
Yes.
That is affordability to consumers. I see there's a lot of reasons to be optimistic for 2026. The industry has a lot of good tailwinds coming into 26.
It's everyone's dream to grow, to be a bigger dealer, to be a better dealer, or even get your first dealership.
Car buying is about the people.
Everybody wants to know what's the car business like, and they like to see under the hood.
Welcome to the Walk Around Podcast.
Hello, and welcome to the Walk Around Podcast. And I'm your hostess today, Heather Wilkinson, and I'm so pleased to be joined by Tyson Jominy from J.D. Power. And we're excited to take a little bit of a step back today to look at the impacts of 2025, the affordability concerns, consumer demand, and interest rates, and hear from Tyson and his perspective on what dealers should be excited about. And Tyson, looking forward to the conversation today, right?
Yeah, Heather, thanks for having me.
Yes, it's very much. So let's start with affordability, Tyson. And, that's been the hot topic. It was a hot topic in 2025 and continues to be top of mind for dealers. Share with us today your perspective on the affordability concerns that dealers have.
Well, a lot of people seem to think affordability is solved or perhaps caused by subcompact hatchbacks. Like if we just have the cheapest vehicle out there, then we have affordability solved. And the reality is that's not how consumers shop. Consumers shop by segment. And if you're a family and you need a 3-row crossover, you don't frankly care if there's a hatchback in that lineup. You need a 3-row vehicle. And so most consumers shop that way. So for consumers to approach affordability, one, it starts by segment. And if you need a 3-row, if you need a minivan or a pickup, or if you're a commuter and you need a car to get you, we have to address consumers with where they are and how they shop to start with. So it's not just show them the cheapest vehicle. It's show them the cheapest vehicle in their segment, and that meets their needs, of course, right? But so that's kind of different from a lot of people think about on the surface. But then, really the way consumers approach affordability, and when I look at my data and my numbers, I always try to take that consumer view of things. It's when you're sitting around the kitchen table paying bills. It's the monthly payment.
Yes.
That is affordability to consumers. I'm a data nerd. I'm an industry analyst. I talk about transaction prices and incentives and vehicle price and all these different metrics. Consumers don't give a rip about that. They want a monthly payment that they can afford. And what are they seeing? Well, of course, in the past several years, a loan payment has gone up pretty significantly. I think we know from roughly $500-ish for a new car pre-COVID to these days $760 a month.
Just under $800 a month is become the norm.
The average vehicle. And it's not just new vehicles, it's used vehicles as well. Back in the day, a $500 used payment would get me a used Highlander. Today, that gets me a used Corolla. I mean, things have shifted so dramatically, both on the new and used side. But there are ways, of course, to address this. The most obvious one, consumers can extend their term. It does help. It does lower the monthly payment. That may not be the right decision.
Right.
And as dealers, we certainly would be concerned, will this consumer stay out of market longer if I put them in a longer term?
One of the things we were talking to a dealer about is that term and the extended terms. And we're starting to hear dealers where they're in situations where customers are looking at beyond a 7-year term, looking at, 96 months. And what's the data telling you about that? And I know it can't be good for a consumer to be financing a vehicle for 96 to maybe 120 months.
Please don't say that.
Right.
I mean, part of the challenge is when we start talking about 84 months, I'll be frank, a lot of consumers can't even do that math because you have to start to use your fingers to do that math. Any loan that goes longer than a lot of marriages is perhaps not something we want to put consumers into, right?
Right.
We really need to, think about that. But for some consumers, that's the only thing they can do. An 84-month loan on a truck, maybe not as bad as an 84-month loan on a used vehicle. So that is somewhat of a concern. What we do see in the data, though, is that consumers in longer-term loans have not significantly adjusted their return-to-market times.
They haven't. So
They
they're
haven't.
still coming. So that's some positive news for dealers.
It is. And it's driven by the fact that used values remain so high. From COVID till now, we've had a significant loss of new vehicle sales.
Yeah.
And when
Not as many consumers were leasing vehicles between 2022, 2023. I know there were consumers that who were in leases, they were buying them out and keeping those vehicles.
Right. We're not just losing that. We're also losing, consumer. We didn't sell a new vehicle. And when we sell a new vehicle, we always get a used trade-in as well. A new vehicle sale is the marble at the top of mousetrap that always starts the whole thing going downhill and creating all the magic. We weren't getting the trade-ins either. So we're losing used vehicle sales from lack of trades. We're losing them from a lack of leasing and then consumers buying up. So we don't have a lot of used vehicles, and that's helping to keep used trade-in values high. So as a consumer, when we're extending them into longer terms, the good news is that the used values are high, and we do forecast them to remain above historical mean really through the end of this decade.
So do you have any data points that a dealer could draw off of as far as acquiring used cars? Is there some type of focal point they could be looking at where they could increase that inventory from a used car perspective?
Well, I mean, I think we all know the oldest rule in the book, how to get more, work your service lanes. I think what we really found when you were talking about buying out leases, a lot of consumers bought out their luxury cars. And when you think about the luxury car lessee, all they've known their whole life is a lease payment and gasoline bills. They don't think about, you don't have to deal with maintenance. You don't have to deal with repairs. And now these consumers bought out their vehicle, their leases. And now for the first time in their lives, they have to get new tires. They have to pay for oil changes, let alone, God forbid something breaks in the car. Now they're in for some serious repair costs. The service lanes, particularly for premium makes, is a fantastic way to source vehicles, because my guess is a lot of those consumers, they want to get out.
Yes.
And they want to trade in that car.
Absolutely. Now, I know that you just recently did some reporting out on the OEMs and some data points around their performance. Do you want to talk a little bit about that today?
Well, I mean, looking at 26, I hear a lot of negativity. Maybe it's because I hang out on Twitter, X, or whatever too much. And, I just see people, being, intentionally obtuse there and pessimistic. I see there's a lot of reasons to be optimistic for 2026. The industry has a lot of good tailwinds coming into 26 that maybe on the surface we don't think about. I mean, interest rates continue to fall. We know that the number of lessees coming back to market this year are going to increase. About 500,000 incremental lease returns are coming to market in 26 from 25. Those consumers have to get into another car. So we have a built-in cushion there of another 500,000 or so sales on top of everything. And in the industry, we're really at a midpoint in the cycle dynamics.
What do you mean when you say midpoint in the cycle dynamics? What do you mean by that?
When we get to the top of the cycle, we'll have 3 to 4 million units on the ground. Incentive spend will be 10 to 12% of MSRP. Fleet channel is stuffed. I mean, we're just putting cars everywhere and trying to move the metal any way we can. We're nowhere near those dynamics. We have 2 million vehicles on the ground for dealers to sell. Incentive spend is contained. We aren't really using the fleet channel very much. So we have a lot of levers and release valves. So the automakers have a lot of options that they can do, either to keep demand high, or if demand starts to flag, they could step in with more incentives and keep new cars selling right now. So we have a lot of good opportunities here in 26.
Well, I love hearing that, Tyson, because coming in, the concerns that we've most recently heard around economic uncertainty, inflation, affordability, gave some concern about the performance of the industry in 2026. Can we talk a little bit about the SAAR and the expectations that you're projecting or may feel like we may end up from a SAAR perspective in 2026?
Yeah, our SAAR math was pretty easy. It's exactly the same from 25 to 26.
Okay, so we're looking to be flat. Okay,
we showed it to everyone yesterday. We're like, no, guys, we actually did the math. This is just how it came out. We weren't getting lazy here. Okay. So we think it's going to be a 16.3 million SAAR again. We're probably on one of the more optimistic ones. But again, we build our forecast from the bottoms up, and all these factors we just went through indicate that we have a lot of reasons that we can keep demand at that level. So we do expect a 16.3 million SAAR. We do expect transaction prices to go up about 2% this year, which means that we don't expect tariffs to be passed through.
And that's interesting. So, because typically we've been hearing anywhere from a 10 to 15% increase being passed through, but you're only hearing 2%.
So automakers are absolutely absorbing those tariff costs. They are getting hit. Those are real. And just because they're not showing up in the market does not mean they don't exist. Automakers are getting them, but they can't pass them through. And this is the interesting thing about the auto industry being it's a global industry, a global supply chain, global production base. So if you're an automaker and you assemble a vehicle in Japan or Korea, and you bring it in and you're getting hit with a tariff and you want to pass that through, you in some cases, you really need to pass that through. You would be the only one in the segment doing that and your volumes would tank. So as a result, particularly the larger vehicles, full-size SUVs and crossovers, so if you assemble yours overseas and bring it in and try to take pricing, you're going to get hit with volume big time because most of those vehicles are assembled in the US. And so that asymmetry is what is keeping a lid on prices. The costs are real. The pricing has been very moderated.
Interesting. Can we talk a little bit about interest rates? I heard you mention as we were going through, you're talking about interest rates. You see them not changing a little bit or going down. What's your outlook for 2026 as it relates to the interest rates?
Well, I'm not an economist. I do play one on podcasts, though. But we do expect interest rates to continue to fall. They're down about 40 basis points on a year-over-year basis as we exited 25. Okay. So there's reasons to be optimistic that interest rates will continue to moderate. That said, they are still in the 6.5% range for an unsupported loan. We do expect to see automakers continue to offer supported interest rate loans for consumers, and that will help in that regard. I mean, when the standard rate is 6% and someone offers you 1.9 or even 0, that's a really big bonus for consumers.
Very much so. And if the manufacturer plans to continue to support with those subvented rates, support with lease programs, it sounds like the outlook for 2026 is a lot more positive than what we may have been thinking prior to in the last month or so, from what I'm hearing you say.
Yeah, I would think so. And you mentioned leasing, and one other way to address affordability is that lease payments are about $120 cheaper a month than loan payments right now. So for a lot of consumers, that was another way we can continue to keep affordability in check is we can get consumers in leases as well, but recognizing not everyone can lease and that takes a little more selling. But again, we are very optimistic, or at least, we think 26 will at least equal sales to 25. Transaction prices will go up, which means the total dollars consumers are spending on new cars in this country will set an all-time record. So we expect to see that grow about 2% as well. So it's a very robust industry. Again, we're not at peak dynamics here. We're mid-cycle. We have a lot of reasons we can continue to do well.
And that's what we want to hear.
Yeah.
Anything on fixed operations that the data has shown that you see for 2026? Dealers are very reliant on their service and parts department and the fixed operations covering their expenses and being able to help maintain profitability. Consumers are now, what's the average age of vehicles? I heard just over 13 years now. How is that going to be a variable for dealers in 2026?
Well, we continue to see fixed ops being, one of the, of course, major profit centers of any dealership operation. We are seeing a number of brands start to do particularly well, whether it's service retention, fixed right first time, doing very well on the F&I side of the business. I don't know if there's any particular, big breakthroughs coming. But, when we look at the three biggest expenses that an automaker occurs after a vehicle is produced, the marketing, the incentive spend, and the warranty. And the ability to impact warranty expense remains so big for automakers. And that's something they're going to continue to focus on here in 26 and beyond.
I think we've got a lot to look forward to based on what you've shared today, Tyson, and we certainly appreciate. Thank you very much for your perspective and sharing the insights from J.D. Power. Again, we are looking forward to hearing more throughout 2026 and looking at a strong SAAR from 2025. We'll be flat, but we're looking forward to a great year.
You heard it here first.
All right. Thank you, Tyson. We appreciate it.
We really appreciate you joining us today on The Walk Around, and we hope you enjoyed the episode. Please be sure to like, share, subscribe, and follow us. We look forward to seeing you next time on The Walk Around.